Hello, today we are going to discuss about the monetary policy. This topic is very important for prelims mains exam. Specifically, it is important for the prelims exam. Now let's get back to the history to understand the background how the monetary policy evolved. Monetary policy, basically the way we see today, like interest rate is revised here, inflation is the target, employment is the ultimate target, then there is a growth and development. The way it is today, the way the monetary policy is followed today was not present in past. In ancient time, the monetary policy was basically related to printing and altering the currency, and thereafter it evolved. Then came gold. Monetary was printed, I mean the money was printed backed by the gold. Gold was required to print the money. Thereafter, the Keynesian theory came, which talked about the government intervention in the monetary policy. So basically, the Keynesian theory talked about that there should be adequate intervention of the government to control the money supply in the economy. And thereafter Milton theory came, which talked about adjusting or revising the interest rate for the monetary policy. And then inflation targeting came, which the inflation became the target of the monetary policy. And at last, after 2008 economic crisis, the quantitative easing concept came, and which started easing the economy by boosting the liquidity. So this is how the monetary policy evolved the way we see today. Now let's talk about the types of monetary policy. Types. Monetary policy is divided into two parts. First is expansionary, second is contractionary. Expansionary, as the word suggests, it means that to expand the economy, to boost the liquidity in the economy, it is expansionary. And for this, separate set of tools and measures are adopted, like decreasing the interest rate, and the purpose is to lower the inflation, to decrease the growth a little bit. So that is the policy of the expansionary, or it is a policy of the contractionary. In contractionary, what happens? Interest rate is increased, and thereafter it leads to the decrease of inflation, and growth is also reduced. In expansionary, the RBI, Reserve Bank of India, decreases the interest rate, which leads to increase in inflation, increase in demand, and which leads to increase in the growth of the economy. So this is how expansionary and contractionary monetary policy is followed. Now let's understand some concept related to the monetary policy, because if you understand the concept, it would be easier to answer the questions of prelims. Let's say this is RBI, which regulate all the banks in India, and SBI, ICICI, PNB, all the banks in India, we know, whether private or public, are regulated by RBI. And ultimately, the public takes benefit from the bank. So these banks depend upon RBI for regulation and also for the interest loan. So RBI charges interest rate from the bank. For sake of simplicity, we take 10% interest rate charged by RBI. Whenever bank take loan from RBI, the RBI charges some interest rate. So let's take that RBI takes 10% for giving loan to the banks, and bank in return, of course, it will charge higher than 10%. So total it comes to, the gap is 2%. The 2% is profit taken by the banks. So whenever the RBI adopts the expansionary monetary policy, it goes for decreasing the interest rate. It means interest would be 8% or 6%, and in return the banks will also charge less than what it has borrowed, like 6% or 5%. So what the bank gets from RBI, it gives to the public. So in this way the interest rate works, and in this way the money supply is controlled in the economy. Similarly, when RBI wants to increase, when RBI wants to follow the policy that is contractionary monetary policy, then it increases the interest rate. Increasing interest rate leads to the increase in interest rate given to the public by the banks. So when the banks are getting at higher interest rate, they will in return give it to the public at higher interest rate. It means when there is a high return, high interest rate, the people or public will be discouraged to take loan, and if they are not taking loan, then it will control the inflation, it will improve the inflationary condition. So in this way the interest rate works. Interest rate basically works on targeting the inflation, because whenever inflation is higher, whenever the inflation is high, it creates problem. And another thing here to note is liquidity. Liquidity means ability to buy or sell quickly. So liquidity in economy is very good, because if we are having money, then we can buy or sell something. A liquidity can be in form of cash, it can be in form of gold, security. So liquidity is good for the economy, but too much liquidity, high liquidity, is very threatening for the economy because it leads to the inflation. So the purpose is to control the liquidity in order to control the money supply in the economy. So liquidity is basic objective. Now let's see some tools of monetary policy. First is MSF, marginal standing facility. MSF is the loan taken by the banks from RBI for overnight, for one night, and for this RBI charges some interest rate, and this is called penal because it is taken on emergency basis overnight. The second one is repo rate. Repo rate is the rate at which the banks take loan from the RBI, and on opposite of this there is reverse repo rate. Reverse repo rate, it is the loan taken by the bank from the RBI. So whenever RBI adopts contractionary or expansionary monetary policy, it goes for repo rate or reverse repo rate. This is often seen in news that the RBI has increased the repo rate by 30 basis point or 40 basis point. This basis point is nothing but 100 part of 1%. So in this way RBI increases or decreases the basis point to control the money to control the inflation in the economy. The next is bank rate. The repo rate is for 14 days, 2 to 14 days, and bank rate is for more than 14 days. In bank rates, the bank rate is not backed by the security, and the repo rate, reverse repo rate, is backed by the security. So whenever RBI wants to increase the money supply or increase the liquidity in the economy, what RBI does, RBI just reduces the repo rate, bank rate or MSF. And whenever RBI tries to increase the liquidity, then it just, whenever RBI tries to increase the liquidity, it reduces the rates, and whenever RBI tries to decrease the liquidity, then RBI increase these rates. This is how it works. Now the another set of tool is reserve. RBI tries to increase or decrease the reserve of the bank to control the liquidity and control the inflation in the economy. The reserves are in form of CRR, cash reserve ratio, SLR, statutory liquidity ratio. Cash reserve ratio is the amount of reserve which the banks are required to keep it with the Reserve Bank of India. For example, if bank gets 1000 rupees, it requires to deposit at least 50 rupees with the RBI, and for depositing this, the RBI does not give any interest on this amount. So this is CRR. SLR is the statutory liquidity ratio. The banks are required to reserve some amount of the total deposit with themselves in form of liquid money. Liquid money like cash, gold, or security. So this is CRR and SLR. So in total amount of the reserve of the banks, like 20 to 23% of the reserve are blocked by RBI. Why this amount are blocked? See, this amount are blocked because RBI, if there is too much reserve with the banks, then there is a high chances that they will give more and more loan to the public, and if they get more and more loan, then there will chance that inflation will increase. To control this, RBI blocks these amounts so that more money will not be lent by the bank. So this is the concept of reserve requirement or of the RBI, CRR and SLR. The next thing is open market operation. Open market operation. There are many people who are not dependent upon the bank to take loan and start the business, like say salaried employed or settle a business. So, but they do have money, and they too this too will increase the inflation, and it will lead to high liquidity. So RBI adopts the open market operation. Through this, RBI buys or sells the security paper. We have often seen that the LIC agent come to us with security paper, and they ask that take this deposit money with us, and after 10 to 12 years we will pay you, we will double the amount. So what does it mean? It means that RBI is adopting the open market operation tool. RBI is taking the excess liquidity from the economy in form of the open market operation. So in this way, RBI takes back those money which is excess in economy, so that the purpose is to control the inflation. So we see that the tools of monetary policy, that is CRR, SLR, repo rate, reverse repo rate, MSF, bank rate, these are tools, and whenever RBI wants to increase the liquidity in the economy, what RBI does, RBI reduces the interest rate. Reducing the interest rate leads to increasing cash flows in the economy. There will be more and more liquidity in the economy, which leads to increase in demand, and increase in demand will lead to inflation. On the other hand, if RBI wants to control the liquidity in the economy, what it does, it simply increases the interest rate of this repo rate, reverse repo rate, MSF, bank rate, or increase the reserve requirement. So what RBI does, RBI increases the interest rate, which leads to decrease in the demand, decrease in the inflation, decrease in the cash flow. So this is how RBI controls the liquidity in the economy, and this is how RBI manages to maintain the growth and development in the economy through controlling the inflation, adjusting the interest rate. So with this, we have understood the concept, how it works. Now let's see the tools of monetary policy. We have already seen the tools that are quantitative monetary policy and qualitative monetary policy. In quantitative, repo rate, reverse repo rate, MSF, bank rate, open market operation, CRR, SLR comes, which we have already seen. What is qualitative? Qualitative monetary policy, under it the moral suasion comes, credit rationing comes, credit ceiling comes, then comes the direct action. So under this, what is moral suasion? Moral suasion means whenever it is a do's and don'ts of RBI for the bank to follow. Whenever RBI wants that bank should follow certain guidelines, or it should not follow certain parameter or guidelines, it issues the moral suasion tools of the monetary policy under qualitative. Credit rationing and credit selling is nothing but the margin required by the banks. For example, if I'm going to buy a car, it will cost me at least 10 lakh, 50 lakh, or more than that. So the banks will not give 100% loan. They will ask that you should pay something and we will pay the rest of the amount. So the reserve requirement, some margin requirement is required, because if we take 100% of the loan, then it will create inflationary pressure, because everybody will take loan without paying the margin requirement. So in this way, RBI controls the money supply in the economy. And next is the direct action. Whenever even after giving consistent warning that banks should follow certain guidelines and it should do away with the certain guidelines, even after that, if banks are not following, then RBI adopts the direct action in form of prompt corrective action, prompt corrective action, PCA. Here RBI takes the management of the bank, it changes the board of director. So in this way, RBI adopts the qualitative monetary policy. One more thing to note here is the qualitative monetary policy is direct in nature. Its impact is direct, because if RBI wants to increase the liquidity in agriculture sector, it just asks the bank to increase the margin requirement of the agriculture sector, whereas the quantitative is indirect. Its effect is indirect, because RBI will change the rate which will affect the bank, and then bank will change the rate which will affect the customer, and ultimately it will affect the economy. So in this way, we see that the quantitative is the indirect and qualitative is direct tool of monetary policy. Now let's see that what are the advantages of monetary policy. The monetary policy has several advantages, because it leads to control of inflation, ensure the growth and development, maintain the liquidity in the economy, adequate liquidity in the economy. It leads to managing the exchange rate in the economy. And there are several disadvantages also, because whenever banks increases the interest rate under contractionary monetary policy, it not necessarily leads to reduction in the inflation. Sometimes when companies they require higher, they are in dire need of money, what they do, they take loan at higher interest rate, and to maintain the profitability, they increase the price of the goods, and which leads to inflation. This is one disadvantage. Another disadvantage is of monetary policy is it does not affect the world economy. It affects the particular section of the country, a particular area, a particular region. This is another disadvantage. And the high liquidity and high expansionary monetary policy also discourages the importers, because they are required to pay more to import the goods. So this is all about the monetary policy. Another is the monetary policy committee. It is the committee formed to control the inflation. The purpose is to control the inflation, and the target is to keep the inflation within 4% range. Maximum it goes to 6%, and minimum range ceiling is 2%. So its purpose is to control the inflation. Inflation targeting is the purpose to revising the interest rate. Monetary policy transmission is the policy, how the policy of the RBI, monetary policy of the RBI transmits into the economy. For example, the monetary policy affect the interest rate, because if the RBI is adopting the monetary policy, it leads to increase or decrease of interest rate, and which ultimately leads to increase or decrease of the inflation, and increase or decrease of the inflation leads to increase or decrease of the liquidity. This is how the monetary policy transmission works. Thank you very much. We'll start with another class next time.